Hello and welcome to the show. Today we're talking about pensions, the often complicated topic of pensions, but don't let that put you off. We're in good hands. Our guest today is Harriet Meyer, who is a financial writer who's written for all the major titles, The Guardian, MoneyWise, etc., and has covered all matter of financial topics over the years. Harriet, welcome to the show. Hello. Perhaps if you could just start by giving us a bit more detail on what you've done.
Yes, so I've been a personal finance journalist and editor for over 15 years. During that time, as you say, I've written for lots of different publications, newspapers, magazines, websites, on all different money matters. So that might range from property, loans, savings to retirement, pensions and investments.
Okay, well, pensions is where we're at today, so let's get straight into the detail. There's been a lot of change, hasn't there, over the last few years on pensions, things like pensions freedoms and the changes to allowances and such. Has that been a good thing, or has it just made it more complicated for people, do you think?
I think it's definitely aimed at being a good thing. It can seem to people that the word pension has become a bit tarnished because the rules keep changing and it's hard to keep up with them, even as a financial writer. So yes, I think it's a good thing because people have more choice and they can take matters into their own hands.
That's a good point, isn't it? Is that historically there's been this thing called the final salary pension scheme, which has kind of gone away a bit, or gone away a lot, and now we have this thing called defined benefit pensions, but also the self-invested personal pension where people can essentially manage their own money. Yes,
so yeah, the self-invested personal pension is a big part of retirement planning for many people now, and it can seem scary because it's essentially a DIY pension. So it's do it yourself, pick your own funds, and effectively you're in charge of your retirement pot. But people shouldn't be scared off by that because there's also ISAs and lots of other tax efficient. There's several tax efficient wrappers you can use. As long as you're saving in some form, then you are essentially saving towards retirement if that's your goal.
You're right. I remember when I got my first SIPP, it was an employer who paid their pension into a SIPP, and you just got cash into the SIPP, and I had to make this decision every month, or at least at the beginning, about what was I going to invest in, and that can feel quite daunting if you've never done it before. That said, there's lots online to help you out.
There's lots and lots of resources, so I think it's just essentially having a little look around, seeing what's there, what resonates with you. There are lots of simple websites, blogs, magazines that can help you make decisions and give you example portfolios for how you can diversify your money and top funds to pick from top fund recommendations. It's not as difficult as it sounds.
Okay, and I suppose that's the point, isn't it? It's about getting started and doing something rather than nothing.
Yeah, I think with a pension, obviously you've got the longevity factor of hopefully the sooner you start, the more time your money has to grow. So you've got hopefully decades to go until retirement when you start saving for your pension. So that's an awful lot of time for your money to ride out the peaks and troughs of the stock market. If it goes down, it hopefully will come up again. So yeah, I think it's just doing something and making that start. And
I forget the number, but there's a really interesting stat, isn't there, about every year you delay, the impact it can have on your return because of the fact that over a long period, this thing called compounding, the fact that you can reinvest income from investments and build that into more investments actually works better over the long term.
Yeah, so you earn growth on your growth. So you essentially you can build at a faster rate the sooner you start because that money will just grow on top of whatever growth you've already got, and then you've got the tax relief in pensions as well. So with ISAs, they're just tax efficient and they the same thing, and they're simple, and pensions, you've got this other boost from the government.
So where do you start? What advice would you give somebody just sort of starting out thinking about their pension? Do you look at a pension provider first? Do you look at investments? Where do you go?
I would say just look at your options. So look around, as we said earlier, about the websites and just think about, so you've got this goal, which is retirement. You want to build a diversified investment pot. So you want to pick a number of funds to put in that pot. So just have a look around, see there's lots of investment platforms out there. So you can pick an investment platform that will suit you and which you think, again, charges, you've got to consider that, and then that will work for you longer term.
Now, charges is an important point, isn't it? Because over time, paying charges can actually have a serious impact on your returns, or at least your investment has to work a bit harder in order to kind of counteract charges. So charges work, I suppose, at two levels. One is a platform charge, but there's also going to be charges for your investments as well. Is that right?
Yes, and I think, how I started and how it would be a good idea to start with, first of all, you want to pick your investment platform. So where am I going to hold my ISA or my SIPP or both? and you need to look at the charges for that, and the charges will vary depending on how much you are investing. So with the same investment platform, you might have lower charges for a smaller sum or higher charges for a bigger. It can vary. There are lots of tables out there, so if you look on websites, you can look at a table and think, right, this is roughly how much I'm going to be investing, so what's the lowest charge for me? Because over time that can make a huge difference. And then you've also got the fund charges as well, which is the second stage.
Yeah, that's right. I mean, there are lots of tables out there. The AIC.co.uk for investment trusts, for example, will show you the different charges for different behaviours. How often do you trade? What's the size of your investment, etc. It's a great place to start. You mentioned diversification a couple of times, and I just wanted to touch on that because that's one of the ways that people can think about risk within their portfolio, that feeling of scariness when you start out and I'm risking my money here. Diversification is one of the ways to deal with that, isn't it? Yeah,
diversification is key. That's a word that's bandied around a lot, but it really is the key to building a diversified investment portfolio, is that you've got lots of different funds invested in different assets. And the idea is that during the same market conditions, when one asset might fall in value, the other might rise. So hopefully, over time, this balances out your returns.
And what about your own investing? Do you practice what you preach? You've been writing about finance for 15 years. Are you also investing for yourself?
Yes, well, I'm self-employed, so I had a mini panic at one point, thinking I need to do something about my pension. I've been, writing about pension. I started off working for the Telegraph, so I had a company pension, but now, I have a SIPP, I have a stocks and shares ISA, and I look at them as a joint way of saving, as a complementary way of saving for my retirement. So they're both tax efficient. And I have a number of funds that I've built up over, so I have probably about 12 funds in my SIPP. Mm-hmm. Some of those funds are also in my ISA. And I don't really look at it very much anymore.
I was going to ask you, how often do you look at it?
I don't like to worry if it goes down, or I just think, well, I'm not going to be hopefully touching any of this money until, with the pension side, obviously not until goodness knows when, but 55 is the age at the moment that's gradually going to move up a little bit over the years to come. But yeah, I just tinker with it now and again, but very rarely, and just stick with those funds.
That's interesting. One of the things, as you say, with the SIPP is that you actually can't get your money, so you're that's good and bad. You're prevented from getting it, but also you might want to get it. And ISA, of course, doesn't have that problem.
No, and that's why I think for me personally, and needing and wanting to have some sort of reserve fund if needed, I've also got you want to keep some in cash as well, and but with my stocks and shares ISA, I can access that if I need that money. But in retirement, I'm hoping ideally I'd like to keep that growing over time and then use that alongside my pension to balance out and produce a retirement income.
Let's just talk about retirement for a second. So back in the day, you would have bought an annuity, which would have paid you a fixed income for the rest of your days. These days, you can stay invested. You can keep the investments that you've bought over your accumulation phase until the point that you retire. You can stay invested and just draw income out from those investments. Is that something you personally intend to do, or do you see value in annuities?
I think
long way off.
I think who knows? Annuity, I think, an annuity is quite useful to provide a small proportion of your retirement income just for your steady outgoings, and then maybe to use, because you have all these options on the pension freedoms now, which again can seem complex, but actually is to your advantage. So you can use, I probably will use drawdown in terms of drawing an income from my investments. And as you say, you can remain invested. The rules changed in April 2015. And it used to be quite rigid, which again would put many people off pensions, but now you can stay invested and you've got the flexibility to do with that as you wish.
And of course, one of the other things that's happened pretty recently is auto-enrolment. Yes. It's forcing people to be in a pension, and I think I'm right in saying that the percentage of your salary that is being paid into pension is increasing over time. Yeah,
so that's gradually increasing over time, and anyone who's 22 or over and earns £10,000 more, so the majority of people who are employed will be automatically enrolled into their company pension, The good thing is that their employer will also contribute to that. But I think because, as you said, the demise of final salary schemes, these aren't gold-plated pensions. You ideally want to be saving in different ways, creating a diversified range of ways that you are saving towards retirement. So that's why I mentioned ISAs as well.
So we always finish our shows by asking our guests for their top tips. What would they be when it comes to pensions, do you think?
Well, I would say just start saving. Don't worry how small amount it is, just start saving and diversify. So spread your assets. Check out charges because they can make a big impact over time. And yeah, just don't panic if there's a drop. And remember, you've got a lot of time on your hands, hopefully, before you retire.
Wise words. Thank you very much. And thank you for watching. That's all we've got time for this week. Don't forget to like and subscribe to the channel, and we'll see you next time. Goodbye.